Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be discussing dividends and dividend reinvestment plans, the All Ordinaries Index and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Let's get into this week's report. Over the decades that I've been helping traders and investors, one of the more common questions I get asked is, what do you think about this stock? The reason this question comes up is because more often than not, the individual asking is losing. In response to this question, I always ask, why did you buy it? And the answer is because it pays a good dividend. But is investing for dividends and using dividend reinvestment plans the best strategy to apply in the stock market? I would argue that you shouldn't buy stocks on dividends alone. A good investment must have capital growth whereby your investments appreciate in value and income from dividends. While both are equally important, depending on your circumstances and where you are in your life, you may place more emphasis on one or the other. That said, I teach traders and investors to develop a strategy that combines both using my 4 golden rules to investing in shares, which I outline in detail in my latest book, Accelerate Your Wealth, It's Your Money, Your Choice. So let's take a look at what dividends are and why you would consider using a dividend reinvestment plan in your portfolio. When you purchase shares in a company, you're entitled to receive a portion of the profits in the form of a dividend. How much you get paid will vary widely. Therefore, it pays to check the company's dividend policy before purchasing shares to ensure it fits with the goal of your portfolio. When you purchase shares in a company, you are entitled to receive a portion of the profits in the form of a dividend. How much you get paid will vary widely. Therefore, it pays to check the company's dividend policy before purchasing shares to ensure it fits with the goal of your portfolio. For example, if your goal was to purchase shares that deliver both growth and income, then purchasing a small cap stock may not deliver the outcome you are seeking, as it may not pay a dividend. Companies usually pay dividends twice a year, although depending on the company's policy, they can pay more or less frequently. You can find out when a company pays its dividends by visiting the stock exchange or by going to the company's website. So when are you entitled to a dividend? Each dividend has a record date and an ex-dividend date associated with it. The record date is the date the company closes its register to determine which shareholders are entitled to receive the current dividend, while the ex-dividend date falls 1 business day before the company's record date. To be entitled to a dividend, you must have purchased shares in the company before the ex-dividend date. There is no set formula as to how a company will calculate the percentage of profits they will pay as a dividend, as there are many factors that are taken into account, which is why this is largely irrelevant. What is important to understand is how to calculate the dividend yield you will receive. A company's dividend yield is calculated as the income you receive from holding the shares expressed as a percentage of its current market price. Therefore, the dividend yield equates to the annual dividend per share divided by the current share price multiplied by 100. For example, if you purchase shares priced at $1 and the company paid a dividend of 10 cents, its dividend yield would be 10 cents divided by $1 multiplied by 100, which equates to 10%. Therefore, when you purchase shares in a company, you secure the price at which the dividend yield is calculated, because your entitlement to a dividend is based on the price you paid for the stock. So what if the price of the stock you own rises to $2 and it still pays a dividend of 10 cents per share? The dividend yield would now represent 5% based on the current stock price. But your dividend yield would continue to be 10% because you purchased the shares at $1. Interestingly, as the price of the stock falls, its dividend yield generally rises and therefore becomes more attractive to investors seeking dividends for income. But some would have you believe that a higher dividend yield means the stock is cheap and an opportunity to achieve good capital growth. Unfortunately, this is only true once the stock stops falling. On the whole, companies that have a history of paying good dividends are profitable. Therefore, I recommend identifying companies that pay a good dividend yield and are falling in value, as they may alert you to stocks that will eventually turn and start to rise once again, so you get both income and capital gain. Many companies also offer dividend reinvestment plans, which allow you to use the money you would normally receive as cash to purchase additional shares in the company. The main advantage of a dividend reinvestment plan is that it compounds your returns because you're reinvesting your earnings. It is also a very effective form of forced savings, provided you know how to protect your capital if the stock turns and starts to fall away. So how does a dividend reinvestment plan work? Well, shares are usually issued at current market prices, although sometimes they are offered at a discount. In most cases, you can nominate whether all or part of your shareholding is included in a dividend reinvestment plan, and the good news if you decide to reinvest your dividends is that the shares are acquired without having to pay any brokerage. Once you receive a dividend payment, the company will issue a statement detailing the allotment of shares you received as part of the dividend reinvestment plan. You should ensure you file this statement with your contract notes so that you have all of the records available when preparing your tax return. Whether or not you reinvest your dividends will depend on your investment goals. For example, if you choose to operate a growth portfolio, it makes sense to reinvest your dividends so that you compound your returns. However, if you are operating a portfolio to generate income, then you would take the dividends as a cash payment. This is more common for retirees who may not necessarily need capital growth and would prefer extra income to support their lifestyle. Interestingly, dividend payments are often more attractive for retirees than receiving rental income from properties, for two reasons. Firstly, because the dividend yield on many stocks is higher than the rental yield on a property. And secondly, when you factor in the cost of maintaining the property, many find the net yield is very low. But what if you would prefer to receive the dividends as income rather than reinvest them? The question is, what should you do with the cash? Now, I strongly recommend you use it to fund other investments. For example, you could take the money and place it in an interest-bearing account to build up a deposit for a home, or use it to pay down your home loan much quicker. Alternatively, you may want to use it to purchase other stocks so as to build up your portfolio. Either way, the important point to remember is whatever you earn for your investments must be reinvested into other assets so that you continue to compound your returns. So there you have it, all you need to know about dividends and dividend reinvestment plans. Now, before we get into this week's stocks, I wanted to announce the date for the live online seminar that I'm doing with subscribers to this channel. The session will start at 7 p.m. next Wednesday, the 5th of December. Now, in order to receive your link to attend, you need to be subscribed to the channel and send an email to info@wealthwithin.com.au. In the subject heading, put YouTube, and then in the body of your email, your YouTube name. We will email you a link and instructions on how to get into the live session. Remember, this is not being recorded and it will not be posted on YouTube. Rather, it is a private session with me where I will answer any questions you have, tell you my thoughts on any stock you like, and share with you many trading tips and hints. Now let's get into this week's stocks. Alrighty, on your screen right now we have a weekly chart of the All Ordinaries Index, and as I was expecting, we were moving right down, but last week, which is the week ending the 23rd of November, we saw some really interesting signs on the All Ordinaries Index, and you might remember me saying that I believe our market is searching for its low, and I believe we may have seen that low, and if I just expand that out, you'll see here how my target was between that 5824 and that 5621, but you can see here it popped right through that support level here that I have, which that bar on the 26th of August found support. I did think our market would find support before it broke through that line, but it quickly turned around. Open right where my pointer is, and you can see there the open was 5822 with a low of 5675. but it came right back to close at 5793. Really good sign for the Australian market. And if I go down to a daily chart, you can see the last 2 days really did pull the market up. So the Friday did close higher, the Thursday, Friday, Monday, Tuesday, Wednesday, more bearish, Thursday, Friday, more bullish. And so that is looking very good. Now, whilst I can't confirm that that is the low that I've been searching for, I thought this could have been it. It was in the time frame and the price target for the low, but obviously it wasn't the low. This could still be the low here, and I am looking for the stock, the Australian market to be more bullish from this point in time. Sorry, I got somebody's now mowing the lawns in the background, so sorry about that if you can hear that. But it is, I do think our market will start to take off. Now, it's a little bit too early to confirm that is the low, or that low of 5675 is the low that we've been looking for. I do expect it will be. If it's not this week, it'll be next week, but I doubt it will be next week. I think if we see a green bar through here, I think then there's high probability over the next 4 to 6 weeks that not only will this high be broken at 6072, that we'll get somewhere right up through into these sorts of levels, probably right back up to this momentum line here around above 6,000 to 6,200 points. So we'll get up into those sorts of levels, and nothing to be worried about. Have a good Christmas, and I still believe our market will move into a high probably March next year, and it should give that a nudge there, that 6481, that previous high there set in August. I think it should break through that, but anything is possible, and we need to be wait to be seen. Some people think just because we make a prediction that we're hard and fast and carved in stone, that's definitely going to happen, and anybody thinks that is not necessarily a great trader in my book. As a trader, we need to put down what we think is going to happen and what we have our preferred plan, but we always have a backup plan. What if it doesn't go up? What if it goes down? I can't control the market. I don't control how far the market's going to rise. I don't control how far it's going to fall. All I can do is control whether I'm getting in or getting out. And I don't buy stocks based on what the market's doing. I don't buy whether the market's going up or down. Doesn't bother me in terms of buying or selling stocks. It's irrelevant in my thinking. It's what I do here is help people understand how the market, or where the market is unfolding to. Because when the market's rising, more people are positive. So therefore, when you're finding stocks to buy, they're going to rise a little bit faster and a little bit more consistently than if the market's more bearish. But again, to me, it's not about whether I'm picking the direction in terms of whether the market goes to 6,000 points or 6,600 points. To me, is really irrelevant. It's making sure that I've got the right direction and I'm picking the right stocks, and that's the major thing. And that's what a lot of people can't do. They sort of speculate on what's going to happen, and they try and bottom pick. They do a whole range of silly things in terms of picking stocks and managing their portfolio, and they really do. There's an old saying that I did at one of my workshops a few years ago, and I said, "Hey, you can't fly like an eagle if you hang around with turkeys." And what I meant by that to our students was, if you keep hanging around with people that don't have the right knowledge and have the right processes and aren't good traders, then you're not going to be a great trader. And I find too many people hang out in things like chat forums and all sorts of places where good traders don't hang out. And therefore you're going to be influenced by people. And I had one of our students say to me, Dale, he said, my mum told me, he said, never take advice from somebody who's poorer than you. And I thought that was interesting, or somebody who has less than you. And I thought that was also an interesting comment. So to me, it's about challenging yourself to be a better trader and a better investor. So and here, getting this right, whether the market goes up or down, is irrelevant to me in terms of, if it goes down, I've got a plan. If it goes up, I've got a plan. I think that's really what I'm trying to share with you. Today, I'm going to have a look at the banking stocks, because the Royal Commission is still just about finished in Australia. But this week, they're in Melbourne looking at NAB, and they're looking at ANZ. Both of those are headquartered here in Melbourne, where I am. So let's go and have a look at the banking stocks. And the first one we're going to have a look at is NAB. And we can see here how the bank's NAB was its all-time high, or that high that it had, was back in April 2015, and all the big four banks had highs in March, April 2015. As you can see here, it fell 36.87% down to that low there in February 2016, and look at this, just recently broke that low into November. I think this is the last gasp, if that makes sense, if that's that last thrust down. Interestingly, NAB this month has gapped right up and then traded all the way through, a little bit like the All Lords, through that level, and now it's come back a little bit. So you can see here this last week, it did open slightly higher than it closed the week before, pushed down, came right back, closed on its high. So we should get a nice green bar coming up through here, and it does look quite bearish. It is still way too early to get into banks at this point in time, but right now I would have them on my watch list, because when the news is the most bearish, that's when you need to start looking. And things that are exciting to me, if I just bring that up, you can see here volumes increasing into that low, big volume down into here and here. So to me, if this volume, we start getting green bars, then we might start seeing, I might start looking at a different, I'll have a different outlook to the banks and saying, instead of them being bearish, I might change my opinion to be bullish. But do not jump early. It is one of those things, people try and bottom pick and they think, well, hey, NAB's at $23. It was up at $30, $40, or what this high is, about $37. So they're thinking, wow, I can get into it really, really cheap. It's always better to wait for it to bounce, to test that low before you get into it. Leave some money on the table for somebody else where it's high risk. Don't go into high risk. Now let's have a look at the next one, Westpac. Again, Westpac had its high back in, what's that one, April 2015. It fell over 30% more recently. If you look at this go down, it's fallen, what's that, 37% if we're looking at that on the monthly chart. It's fallen below all sorts of different support levels there. But again, it is bouncing back those last few days. And if we look here back on a weekly chart, it pretty much opened where it closed the week before, traded down, came and broke back up again, and has closed on its high for last week at 26.04 is what it closed. Again, volume's a little bit more, not so much as pronounced as what NAB is, but it's a little bit higher, but not so high that it's something that is exciting to me. It did have a lot more volume through here, but we'll wait and see what happens here. But it does look like it will trade up this week. How far it trades up, if it can't break through that level there at 27.91, I think this will keep falling away. But if it does fall away, it will only go down to about that $24 mark, which is on that left-hand side chart. But right now, again, stay out of banks until we get a little bit more confirmation. Here's Commonwealth Bank, and on your left-hand side of your screen, you can see there's green areas where I was expecting the lows to happen for our banks. Now, Combank looks even stronger than any other bank, doesn't it? We've had it come down into a low, and we've had 1, 2, 3, 4 weeks up, and this week it opened, traded a little bit lower than the preceding week, and closed on its high. So this is really exciting. Combank is probably the one I'd be looking at for probably the earliest entry into a stock, and it is looking like it may have found some support and starting to move up, and therefore my prediction of where it would have its low is pretty close, actually. And as I said, just waiting for a little bit of confirmation on that to make sure it's finished falling before I would get into that with my money and our clients' money. Looking at the last one, ANZ, another one of those ones that it's looking a little bit more bullish than the others. It fell 41.32%. So ANZ and Combank are my two preferred, obviously with Westpac and NAB being less preferred at this point in time. But ANZ really did fall heavy. And we go to that weekly chart, we can see here how it had that low, its low back in October. We've had 1, 2 really nice good bars up, 1 bar down. Last week was an outside bar, so it gapped down, traded down, and came right back, closed on its high. Volume's looking pretty good, so if it does start to move up from here and start to break through that high of 27.42, I'd get a lot more excited about this stock, and I think it is looking a little bit better. Obviously, the pick of all the banking stocks is Macquarie, and I'll actually just bring that up briefly with you. I'll have a look at Macquarie. And where is it? That didn't type, did it? It's on the S&P 500. There we go. Now, come on. You can do that better than this. I'm just typing in the wrong things, aren't I? So looking at Macquarie, have a look at that. Macquarie has been the best bank Obviously, it's not in the big four, but it has been the best performing bank with its high back in September. Right now, it's looking a little bit more bearish. So I think what's happening is probably the big money is moving out of Macquarie and starting to move into those bigger banks. So, and we can see here a little bit of volume going down, increasing on these downward moves. So right now, I'd be looking at whether I would hang on to Macquarie if I was an owner of Macquarie. I'd be looking for a possible exit on that, and I would not be looking to enter into Macquarie. I would be looking, as I said, at CBA first, and then probably ANZ second, with NAB and Westpac third and fourth. In that sort of order, I'd be looking at it. But good luck, good trading. Talk to you next week. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillam, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.